Meet Katsu. Katsu is self-employed and bought a car to use for his business. While he can't deduct the direct cost of the car, he can claim either a capital allowance, a yearly amount based on the purchase cost, and actual running costs of the car, or a mileage allowance for the business miles he travels. There are two key methods for calculating motoring expenses for cars: actual cost method and mileage method. In order to work out which one is better for his business, Katsu decides to calculate both. He starts with the actual cost method. This will enable him to work out the business proportion of his vehicle running costs. In addition to the vehicle running costs, Katsu will also be able to claim capital allowances. These are restricted to the business use of the vehicle. Katsu must keep a record of all his motoring costs. To use this method, Katsu must first make a note of his mileage reading at the start and end of his accounting period. He will have kept a record of his business mileage for that period, which is 3,500 miles. He uses this information to calculate the business proportion of his motoring costs. Next, Katsu will need to add up all his motoring costs and multiply the total by the percentage of his motoring costs that relate to business use. Let's see the actual figures involved in Katsu's case. He works out that during his accounting period, 60% of his vehicle's mileage related to his business. He then adds up his motoring costs. He then needs to work out the amount represented by 60% of these costs, since 60% of his car use is for his business. As you can see, the total he can claim for with the actual method cost is £1,956. For the mileage method, Katsu needs to use HMRC's Approved Mileage Allowance Payment (AMAP) rates to calculate his motor expenses using a fixed rate for each business mile. In this calculation, Katsu multiplies the 3,500 business miles he has driven in the relevant tax year by 45 pence a mile, which equals £1,575. If he had travelled more than 10,000 business miles, then a reduced rate of 25 pence would apply for each mile over 10,000. Note that these mileage rates are published annually and can change from year to year. So when you're making your own calculations, check which rates apply in the current year. Note too that the annual mileage payment rate can only be used where the VAT threshold is not exceeded. Katsu can only use one of these methods to work out his motor expenses and must use the same method until he changes the vehicle. He can choose whichever method is better for him. Although he finds the annual mileage rate method more straightforward, he may find it financially beneficial to claim his actual vehicle running costs plus capital allowances. Why not try our Business Mileage Calculator and Capital Allowances for Cars tool to work out your motoring costs?